Dave Franecki here. I'm the fund manager of Capstone Capital USA, and we're a niche note investment group, and I'm also the organizer of the Note Investors Forum here in Phoenix Mesa area. So Capstone specializes in several niche markets. We buy, we sell seller finance notes. We also help investors deal architect notes that they're looking to finance, and also we connect with sellers, home sellers, to sell their home on seller carry. That's our niche. We're recognized for that, and it's something that I'm really proud of. Okay, so we had done a couple of other educational audios, videos about the due diligence process. I'd like to expand on two pieces there. This is note seasoning and verifiable payments. And here's something that you might not have thought of. There's not just one single item that determines the value of your note. But as we discussed in the prior videos, seasoning and payments are a big piece, in addition to the credit and other things we talked about. But note seasoning might sound a little bit cryptic, if you will, but it breaks down to one of the biggest potential performance indicators of a note. So what is note seasoning? And note buying seasoning refers to just how long the payments have been made on the note. Think of it as an experience factor or reputation. This is what an investor is looking for. So how long has the buyer, the payer, been making payments? And if he's paid late or missed any payments, what's that all about? If he's more than one payment late in the course of 12 months, it's a subperforming note. Now, if he pays within 30 days or she pays within 30 days, it's not considered late. And also, are the payments verifiable? That's why I mentioned in a prior video that you use a third-party servicer. So when you're buying from some people, a private note seller probably won't be using a servicer. I've had people come to me with pictures of cash. Well, here's the payments. Or they have a handwritten receipt book. Really? Come on, man. That's not verifiable. What we're going to want in that case is a copy of the bank statement with their account number blanked out, maybe some other personal information showing the sequencing of the monthly payment. So that's verifiable. Like I said, third party is best. You can also, maybe an attorney will do that for you, maybe an accountant. But if you don't use a third party, it could be kind of tough. And when the sellers, when the payers pay you, get a copy of the check. Make a photostatic copy of that. PDF it. Put it in your hard drive. Keep copies of the deposit tickets. In other words, more is better. Less is not better. So the payment histories, the records showing the payment date, the amount received, the breakdown of the principal and interest on your amortization table. This will go a long way in showing the note stability for if you're looking to sell your note or just have it. What if you pass? Your heirs want to see what's going on. Or when what's if the payer calls you and says, well, how much do I owe you now? You got to be able to tell them. Payment histories increase note values. Talk about seasoning. General rule: the longer the better. Can you buy a note when it's just been created? Yes. Would you want to pay par or what the value is? Probably not. You have no idea if that payer is going to be paying on time or not. You're taking a risk. So a lot of seasoned note folks won't buy a note unless it's got at least 6 months worth of seasoning. 12 months is better. The more months is better. If you're buying something that doesn't have any seasoning or very little, credit scores become more and more important. 620 or above, 650, 680, whatever it might be. Doesn't matter if it's dirt, whether it's a house or whatever it might be. If it's an LLC, it's a bigger issue because typically that particular payer has not signed on personally in terms of being personally indemnified or personally responsible for the note. So, and I also make note of that it's 12 months in a row. Sporadic history or rolling 30s or rolling 60s, that kind of makes it a subperforming note. It hurts the value. So if you're a note seller and you have that and you haven't enforced it, it's going to cost you when that note buyer comes in and says, I want to buy your note. They're going to hurt you with the discount. But they have to do that because they're looking at a quantifiable risk. So stable payments is important. So even in any of these situations, the note still can be sold. It's just a function at what price it makes sense to the note buyer, the note investor. So it's not just these two factors. We talked about the other factors, the factors of due diligence. They all kind of come together into the whole process. Now, one last thing. As I mentioned, a lot of this is brought forward in our note holders handbook. 70 pages of great stuff, 30 pages of narrative goes into the variables of a note, and another 40 pages of glossary. Looking for other notes to buy? At the bottom of the screen is a link to the Capstone Capital Note Vault. We have some great stuff in there. These are seasoned, they've been verified, lots of due diligence. Are they risk-free? Absolutely not, but they're good. So look forward to talking to you soon. And by the way, you can always shoot me an email. Email's at the bottom of the page. You can call me if you will. I will get back to you with questions. I'm welcome to talk with you. Have a great day.